Japan's Nikkei stock index hit $38,915 on December 29, 1989. It took 35 years to get back there. That is not a correction. That is a generation. Here is the receipt nobody in the UK is reading. Japan spent 3 decades in a demand trap so deep that prices fell, wages flatlined, and growth basically stopped. The mechanism and why falling prices are actually more dangerous than rising ones. The policy playbook Japan ran and exactly why it failed. And the UK signals that look uncomfortable right now. Stay till the end. The third one changes how you think about all of this. Start with the bubble. Japan in the 1980s was running one of the hottest economies on the planet, borrowing against rising asset prices, land values through the roof, corporate Japan buying everything from Rockefeller Center to Pebble Beach. The Bank of Japan kept rates low to support growth after the 1985 Plaza Accord pushed the yen up sharply. That cheap money flowed straight into property and stocks. And then, in 1989 and 1990, the Bank of Japan hiked rates to cool things down. That is all it took.
Here is what the demand collapse looks like in the actual numbers. Japan's GDP growth averaged over 4% annually through the 1980s, Cabinet Office Japan data. From 1991 to 2019, that average dropped to under 1% per year, according to IMF World Economic Outlook records. The economy did not crash overnight, it just stopped moving. And a slow-motion stall is actually harder to fix than a sharp crash because nobody rings a bell when it starts. And here is the thing that breaks most people's mental model. We are trained to fear inflation. Prices go up, money gets worth less, savings erode. Bad. But deflation, prices going down, sounds almost fine, right? It is not. When prices fall consistently, consumers wait. Why buy a washing machine today if it will be cheaper next month? Multiply that logic across an entire economy, across millions of households, and you get what Japan got, a demand freeze that compounds every year. Japan's consumer prices fell in 1999, 2000, 2001, 2002, and 2003, 5 consecutive years of deflation. That is Bank of Japan CPI data, public record. Not a dip, a structural trap. And when deflation becomes the expected norm, it is extraordinarily hard to break because the expectation itself suppresses spending before prices even move. But here is what most people get wrong about Japan. They blame the banks, or the slow government response, or demographic aging. Those are all real factors, but the root cause is a demand story. Richard Koo at Nomura Research Institute coined the phrase balance sheet recession to describe exactly this. Companies and households watched their assets collapse, then spent the next decade paying down debt instead of spending or investing. The private sector went on a spending strike. That is a completely different beast from a normal recession. A balance sheet recession has a specific fingerprint. 5 signs you are in one, and Japan ticked every box. Japan checked every single one of those boxes for decades. And here is the bill. By 2023, Japan's government debt had reached around 255% of GDP, IMF Fiscal Monitor 2023 data. That is the accumulated cost of 30 years of trying to fill a demand hole with government spending, while the private sector kept saving instead of spending. The government outlays kept the lights on. They did not fix the underlying demand collapse. The Bank of Japan introduced near-zero interest rates in February 1999. That is Bank of Japan policy records. They are still near zero in 2024. 25 years of near-zero rates, and the economy only recently started showing inflation again, partly because global commodity prices forced it. That is how sticky a demand trap gets. The usual lever, cutting rates, just stops working.
Now, hold that against the UK after 2008. The Bank of England cut rates to 0.5% in March 2009, Bank of England MPC records. They held near zero for over a decade. The stated aim was to stimulate demand and get the economy moving. What it mostly did was inflate asset prices. Sound familiar? The playbook is not identical to Japan's, but the shape of it is uncomfortably close. Here is the third payoff I promised, and this is the one that reframes the whole story. The UK did not fall into a Japan-style deflation trap after 2008, but the underlying demand weakness never fully resolved. UK real wages in 2023 were still below their 2008 peak, according to ONS average weekly earnings data, a 15-year wage freeze while prices kept climbing. Japan had that exact pattern. It just happened earlier and lasted longer. So what are the actual warning signs that demand weakness is becoming structural? Not the alarming headline version, the observable version. 3 things Japan's experience consistently points to. The UK household saving ratio jumped to around 25% in Q2 2020, ONS household saving ratio data, the highest since ONS records began. It fell back, but the pattern of households choosing to save aggressively when uncertainty spikes is exactly what Japan showed in the early 1990s. Not the same scale, not the same duration yet, but the same instinct. And that instinct is what feeds the trap.
The IMF put it plainly in their 2023 Article 4 consultation on the UK. Slow potential growth, weak private investment, and persistent real wage weakness are the structural headwinds. That is not my editorial, that is the fund's own published language. Japan had all 3 of those for 30 years. The UK has had 2 of them since 2008. And here is the bit the London-focused analysis always misses. This demand weakness is not spread evenly across the country. ONS sub-regional productivity statistics show a persistent gap in output per hour worked between London and the English regions that has not meaningfully closed in 20 years. Japan's demand collapse was also regionally concentrated. Tokyo absorbed most of the recovery while everywhere else waited longer. The UK has the exact same structural geography. Japan is not a cautionary tale about Japan. It is a blueprint for how a demand-driven economy locks itself into a low-growth loop and then cannot get out using conventional tools alone. The Nikkei took 35 years to recover. Japanese real wages still trail their 1990s trajectory. The UK is not Japan. Different scale, different context, different timing. But the mechanisms are not exotic. They are just slow enough that nobody panics until it is too late to change course cheaply.
If this landed, the video on how Bank of England rate decisions flow through to mortgages and wages goes deeper on the UK side of this. Subscribe if you want the analysis without the noise.